Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Alhamdulillahirabbil alamin wassalatu wassalamu ala asyrafil anbiya'i wal mursalin wa ala alihi wa sahbihi ajma'in. Today we are exploring a fascinating question. How does Islamic finance compete with conventional finance in the global market? We will dive into what makes Islamic finance unique, its challenges, and its growing in global presence. By the end of this video, you will have a clear understanding of how these two systems impact economies around the world. First, let's talk about what a financial system does. At its core, any financial system, whether Islamic or conventional, aims to manage money, loans, investment, and risk to help economies grow. Conventional finance is based on capitalist principles, often driven by profit and interest, while Islamic finance follows Sharia law, emphasizing ethics and fairness. Now, what makes Islamic finance unique? Islamic finance follows several key principles laid out in Sharia law. One major principle is the prohibition of riba, which means interest. Instead of earning fixed interest, Islamic finance focuses on profit sharing. For instance, if you get a loan to start a business, you and the bank might agree to share any profit or loss. This way, the bank takes on some risk with you, promoting fairness. Another principle is the avoidance of gharar and uncertainty. This means all contracts in Islamic finance must be clear with specific terms. And finally, maisir or gambling is also prohibited. So, Islamic finance avoid investment in industries like gambling and speculative trading. To bring these principles into practice, Islamic finance uses several specific types of contracts. Let's go over a few. First, murabaha. Murabaha is a cost plus profit sale, often used in financing. Here, the bank buys an asset and sells it to you at a higher price with profits included. Second, mudarabah is a profit-sharing contract where one party provides capital and the other manages the business. If the business does well, both parties share profits. If it doesn't, the capital provider bears the loss. Third, ijarah works like lease. In this case, you pay for the use of an asset such as an equipment or property, but you don't own it. The ownership remains with the bank. These contracts ensure both parties understand their risks and responsibilities, creating balanced and ethical financial relationship. Now, let's switch over to conventional finance. This system has dominated the global market for centuries. Unlike Islamic finance, conventional finance is based on earning returns through interest, which means banks and investors get a fixed amount of money back in addition to the principal, no matter how the borrower's project performs. This interest-based lending has advantages in terms of predictability for lenders, but it also means that the borrower bears all the risk. Conventional finance allows for investment in any legal sector, such as alcohol or gambling. This freedom provides more flexibility, and it's common for banks to use derivatives, bonds, and stocks to grow profits. However, this profit-driven approach can sometimes lead to instability, as seen in the 2008 financial crisis. Now, let's summarize the key differences between Islamic and conventional finance. First, Islamic finance emphasizes ethics and prohibits interest, whereas conventional finance uses interest to drive profits. Islamic finance promotes risk sharing, so everyone involved in the transaction shares the potential for profit or loss, while conventional finance places the risk primarily on the borrower. This ethical foundation attracts not only Muslim investors but also those interested in socially responsible investing. This ethical focus in Islamic finance encourages transparency and fairness, which can appeal to investors worldwide, including non-Muslims. Now, let's take a look at how Islamic finance is growing and competing globally. One example of this growth is the sukuk market. Sukuk are Islamic financial certificates similar to bonds, but structured to comply with Sharia. Countries like Malaysia, Indonesia, and Gulf Cooperation Council (GCC) countries are leaders in the sukuk market, providing global investors with Sharia-compliant alternative to conventional bonds. In fact, Malaysia holds over 60% of the global sukuk market. This strong presence is a testament for the demand for ethical investment options and shows how Islamic finance can compete on a global scale. Let's take a closer look at some countries leading the way in Islamic finance. First, Malaysia. Malaysia has developed a robust Islamic finance industries, with almost half of the country's banking assets in Islamic banks. The government actively supports this growth with incentives and policies, creating a strong Islamic financing ecosystem. Second, Indonesia. As the country with the largest Muslim population, Indonesia's Islamic finance market is rapidly expanding. The government has implemented various initiatives like public awareness programs to increase the adoption of Islamic finance products. Third, GCC countries. Countries like Saudi Arabia and the UAE have also embraced Islamic finance. Saudi Arabia, for example, funds a major infrastructure project through sukuk, providing growth opportunities while staying aligned with Islamic values. Fourth, United Kingdom. Surprisingly, even the UK has a strong Islamic finance market. London has become a global hub for Islamic banking, with several international banks offering Sharia-compliant services and the government even issuing sovereign sukuk. This shows how Islamic finance can appeal across different cultures and regions. Islamic finance has unique strengths, especially its resilience during financial crises. For instance, in the 2008 financial crisis, Islamic banks were more stable than many conventional banks. Since Islamic finance avoids risky derivatives and doesn't rely on interest, it's often better equipped to handle economic downturns. This resilience makes Islamic finance appealing for those who prioritize long-term stability over quick profits. Another strength is the rising demand for ethical investment globally. With many people looking for socially responsible options, Islamic finance stands out as a system that naturally aligns with these values. But there are challenges too. Islamic finance still has a smaller market share than conventional finance, partly due to limited awareness and fewer product offerings. While there's been a significant growth, Islamic finance is less established in areas like financial technology, fintech, compared to conventional finance. This slower pace can make it difficult for Islamic banks to compete, especially in rapidly changing markets. To address these challenges, experts recommend greater innovation in Islamic finance products and better collaboration with conventional financial system. This would help Islamic finance gain more recognition and reach new audiences. Looking ahead, the future for Islamic finance looks bright. Global assets in Islamic finance are projected to grow annually by 10% to 12%, driven by increased demand for Sharia-compliant products, particularly in Southeast Asia and the Middle East. As more people prioritize ethical investing and sustainable finance, Islamic finance could continue to gain ground. With more education, innovation, and collaboration, this sector has the potential to make an even greater impact globally. In conclusion, Islamic finance offers a unique and competitive alternative to conventional finance, driven by ethical principles and commitment to fairness. While challenges remain, Islamic finance resilience, ethical appeal, and growing global demand position it as a powerful competitor all around the world. Thank you for watching. If you found this discussion valuable, please like and share. And remember, finance isn't just about profit, it's also about principle. Assalamualaikum warahmatullahi wabarakatuh.